it says that if beneficial owners believe, so this was in response basically to the letters in argument that it would, if they passed this rule, it would continue to facilitate illegal short selling. And 7 people actually wrote letters describing how it aided and abetted illegal short selling, which I thought was very blunt and very ballsy of them to include, just being like, so we've been accused that this might be helping some really illegal activities, but don't worry about that. Just don't worry about it.
Now, don't look behind the curtain. Yeah. There's nothing to see. Nothing to see back there.
No. But yeah, so then they said, if beneficial owners believe that their interests are best protected by not having their shares subject to book entry transfer at DTC, then they can instruct their broker dealer to execute a withdrawal by transfer, which will remove the securities from the DTC and transfer them to the shareholder in certificated form. Is that just sounds like DRS to me, but I'm not sure. Is that essentially what's happening? Is that DRS that they're describing?
So at the time that all this, when they were circling the wagons, it was all about, their argument was always about certificates. Like, we don't want them out there. They cause too much trouble. They get lost, whatever. So like that certainly was, certificates were the issue at that point. And so once I established DWAC, direct withdrawal at custodian, where the broker sends an instruction to DTC, DTC sends it to ComputerShare, and ComputerShare opens an account for whatever, Susanne Trimbath, and then your shares are out. Once that was established, and then the transfer agents and issuers just ran with it, and they said, we're going to get, the more of this we have, the less we have to deal with DTC as the 800-pound gorilla in the room, right? So it really was like all of the arguments were focused around certificates. But if you'll notice, when the rule came out, it actually said all securities issued by those companies. It wasn't just about certificates. So they were anticipating that already.
Yeah, well, I mean, they'd be really stupid not to. Like, I think they really saw what was coming in terms of like high frequency trading and just technology taking over finance. Because when did they go?
The bad to worse, year-end 2007, NSCC had a clearing fund. That's the money that they would use in the event that Robinhood couldn't fulfill their obligations. 4.9 billion in the clearing fund, 7.5 billion of positions, about 50%, right, was covered. Year-end 2021, they had 26.2 billion in the clearing fund and 185 billion in open positions.
Whoa, that is quite that's a ridiculous amount of growth.
7 times. So the open positions were 7 times what they had in the backup. And prior to comments that I put out to the SEC on some proposals in like 2003 and 4, they didn't even include. There's a formula that they use to figure out how much each participant has to put in that fund. They did not include the fails to deliver in that. So that's why it just kept getting bigger and bigger. So right now they have 14% or something, but even a broker is required to keep 25% as like a cash capital backup, right? So how they're getting away with 7 times. So the value of what they'd have to cover in the event that it all falls apart, is 7 times what they have to cover it with. There is no, to my knowledge, like if you have a broker account, you have SIPC, but SIPC did not pay anybody who got money from Bernie Madoff. They went after the people who had withdrawn funds from Bernie Madoff and said, those are not really like your money. We want that money back to pay the people that didn't get anything. So there was this whole question of whether or not SIPC, it really protects you at the broker. FDIC is pretty good if you put your money in a bank up to a certain limit and the bank fails, even by fraud, which the FDIC would still cover because that's real insurance. But I don't know that there's this, the insurance that they have is really just the assurance that they're too big to fail and that the federal government will come after them, will come and support them. And as far as the Federal Reserve Bank being that backstop for them, what the Federal Reserve Bank did to backstop like AIG, credit default swaps, all that in 2008, That was actually, like, it had to be made legal the night before they did it. It wasn't really legal for them to do. Like, they're not supposed to give money, for example, to companies. Like, they're just all about banks. They're not really about giving money to companies, but they did through the Treasury. Like, they worked with Treasury. Another thing that they weren't supposed to do that they somehow managed to get done because of these emergency rulings that they got. So there really isn't there, that business about the Federal Reserve having some insurance policy. I don't, not to the best of my knowledge, unless something's happened that I didn't see, I don't know that they have any type of insurance to cover this problem.
So it's more just like theoretical, too big to fail money.
Well, I mean, I see it that way. And then also there's this movement towards making them quasi-government. So the latest proposed rule that came out about the SEC being able to appoint boards of directors, not appoint boards of directors, to require a certain number of independent directors at SROs, at DTC, stock exchange, etc.
It's mind-boggling that that's like it is an independent and private body. Like, that still blows my mind. Like, for people that don't realize this, who are listening, right? And I'm sure most of the people who are listening to this are already very aware, thanks to a lot of the stuff that's been written. But like, the DTCC and the DTC and the DTC and the NSCC are not like a government body at all. It's and correct me if I'm wrong, they're basically made up of all of the people that they are regulating, right? Yeah.
Yes.
Like,
they're owned by, and their board of directors is composed of the people who use their services. That's the definition of self-regulation. New York Stock Exchange is the same way. American Stock Exchange, NASDAQ, all of the OTC, not OTC, the OCC, right? The derivatives markets, they're all self-regulatory, which means that the people who, trade are regulating trades, which is just,
it's like
boy.
trust me, bro, governance. Like, it's incredible. Thanks for making it all the way to the end of the video. Don't forget to like, share, subscribe, and leave a comment for us in the comments below. Let me know what you thought and if you'd like to see more of this from the show. Thank you, and we'll see you again next time.